Hello there, this is Rodney again with Zero Stress Business Funding, the Oasis Funding Network. The title of this video is Don't Get Double Dipped. So what is double dipping by a lender? Because no, we're not talking about when you're at the snack bar. Double dipping is a little thing in the lending industry that most lenders and loan brokers don't like to talk about. They like to keep it on the DL. Why? Because one, it's a way for the lender to make a lot more money on your money than they want you to know about. And second, because the broker or the person selling the loan, they want you to think you're getting as good a deal as possible and you're paying much lower interest than you might think you're paying, so that you'll be more likely to say yes and sign on the dotted line. So, of course, I know what you're thinking. What the heck is double dipping when it comes to loans? Well, let's say, for example, you get a working capital loan, unsecured, at 15% simple interest, which is actually a very low rate for high-risk, unsecured, no collateral working capital. And let's say you get, for easy math, $100,000 at that rate, $100,000 loan. Many working capital lenders are then going to tell you, hey, you know what? At 50% paid in, you can refinance, get more money, maybe even a lower rate, and we will extend your term out longer. And in that case, it might be easy for you to think, wow, I can get more money every so many months, keep refinancing, get regular infusions of cash, almost like having a credit line, and I'm keeping my costs at 15%. And after I take my tax break by writing off all of that 15% of interest expenses off at the end of the year, I'm only basically paying bank rates without having to deal with all the baloney paperwork and delays that the banks want to put me through. And since it's unsecured money, there's no collateral, nobody can take my house or my stuff if things go south. Sounds pretty good, right? Well, with some business owners, this still, even with the double dipping that I'm about to explain, might be their best option, still may have advantages that make it more attractive than going to a bank, but it is not what it appears to be on the surface. Why? Well, let's dig a little bit deeper. The lender is going to be making considerably more than that 15% on your money, even if they charge you zero origination fees. How are they going to do that? Well, let's say that they are willing to give you up to another $100,000 loan when they refinance. So remember, you originally borrowed $100,000 at 15% simple interest, which means that the payback would be $115,000 total. Remember, these loans do not use an APR or an annual percentage rate. It's not 15% a year. It's just a flat 15%. So 50% paid in on $115,000 that you owe once you include the interest would be $57,500, because that's half of your total payback of the $115K. So you now still owe $57,500. So if they will loan you another $100,000, which would be generous, then you are going to be refinancing that $57,500 that you still owe on the first loan into the $100,000 second loan, which is going to leave you $42,500 that you can spend. But here's the thing. You are paying the 15% interest on that $57,500 from the original loan, which a portion of is interest from the first loan. That means that you are paying on the new loan interest on the interest of the previous loan. So you're paying interest on your previous interest, not just on the original principal. Plus you're paying another 15% interest on the additional $42,500. And every time you do this again, every time you refinance again, you are paying more interest on your previous interest. The amount of interest that you're paying interest on keeps going up. The amount of interest you're paying on interest keeps increasing, which means that the lender is making way more than 15% on your money. Are you confused yet? Does that make sense? But they're not going to want to tell you this. Now, I admit, we do have lenders that do that as well, but we also have lenders that don't double dip. And we will only use the ones that do double dip if we have your permission, and then only if for some reason we can't get you qualified for the ones that don't. If that's the only funding we can get and you're still going to make enough money with that money to make it worth it, we might have to go that, you might choose to go that route. But if not, hopefully we don't do that. So now pay attention. Here's how the lenders that do not double dip work. Now, they might actually charge you a couple points more on that first loan. So let's say instead of 15% simple interest, you're paying 17% simple interest. But when you get more money, they don't refinance the old money into the new money, into another loan. Instead, they give you a completely separate second loan. And you can usually net more money than in the previous example. So instead of only getting 42.5, maybe you can get 50 or 60, whatever the case might be, to use in the next installment. But the key point is you do not make any payments on the new money until you finish paying off that first loan. So you are always only making one payment at 17% or 15% or whatever the first loan was at. Since that loan is not refinanced into the new loan, you are never paying interest on your own interest, which is interest on money you were never able to use anyway. With the other lenders, you are paying interest on the money that they are charging you to lend you the money. Confused yet? Yeah, it's a bit circular, basically a vicious cycle. Why should you pay interest on money you never really received? Why should you pay interest on the money they are charging you to borrow the money? Now, we can get you that original loan of $100,000, plus, instead of refinancing it into new loan, we'll just get you a new infusion of cash every so many months, depending on the term of that first loan. But you always know exactly what you're paying in interest. You are never paying interest on interest. You just have one payment because you're never paying on the next installment until the one before it is paid off. And you can still count 100% of that interest at the end of the year as a deduction. Get a bunch of your interest back on your taxes and basically truly be paying close to bank rates without all the nightmare of dealing with banks, no collateral, nothing they can take if things go south, and all with minimal documentation and extremely fast closing and funding. If this sounds like a scenario that you might be interested in, as it truly can be better than a line of credit in many ways, because one, the money is more usable and accessible because it's in your own account, not in the lender's account, and often less expensive once you take into consideration the tax breaks especially. So if this is of interest to you, please call or text 442-222-9429. If you're watching this on YouTube, there's contact info in the description below. If you're watching this on Facebook or somewhere else, there should be contact info in the description of that post. If you're on my website, of course, it's very easy to see how to get a hold of us. Please reach out as soon as possible for a zero stress, no obligation, no pressure, no expectations consultation. Happy to help and answer any questions that you might have. Till next time, we'll see you next time.